Hello viewers, today on this episode of vishalvealthview, we have US and China sitting for a trade talks in London. This is coming in the backdrop when the exports from China has dropped by a third as this trade war escalates. The Nasdaq 100 index has rebounded since the tariffs were announced in the month of April, but the broader American economy is in the risk of recession. The quarterly GDP for US declined in the first quarter of Trump's presidency by almost 0.3%. This is making the markets and the investors jittery, and over long term, this is leading to a increased premium over US assets. However, on the other side of the planet, Nifty has recovered back to 25,000 range, with India becoming the fourth largest GDP and a growth of almost 7.4% in the last quarter. This boost in public sentiment, along with ceasefire holding with Pakistan, is leading to a setup for bull run in India. Some sectors are already in the bull run phase, with defense leading the charge after the stellar performance of military equipments of Indian companies in India-Pak conflict. As the world enters into a more turmoil phase, I believe that this trend is likely to continue. Let's start with tariffs and trade war. In the beginning of this year, Trump announced tariffs on almost all countries and all the trading partners of US, with China being the primary focus. The main reason for this is unfair practices of trade by China, and secondly, China is the adversary of US, and to some extent, US want to contain China. This trade war actually began in the earnest on July 6, 2018, when the United States imposed 25% tariffs on $34 billion Chinese goods. Since then, it has been escalating. Throughout 2018-2019, both nations imposed additional tariffs, leading to a prolonged period of negotiation, partial truces, and renewed escalations. The COVID-19 pandemic fueled this fire, and the global economic shifts in 2020 and 2022 saw some easing in these tensions. But the underlying disputes over technology, intellectual property, and market access is persisting. When Trump returned in 2025, his presidency escalated this trade war sharply. The US imposed 34% reciprocal tariff on most Chinese imports on 2nd April 2025, in addition to a pre-existing 20% tariff, raising the total to almost 54%. China responded with a matching 34% tariff on all US goods and implemented export restrictions on critical rare earth minerals. Since then, there was a trade deal that was announced on May 12, 2025, following high-level negotiations in Geneva, where both countries agreed to a temporary reduction of tariffs to 10% on a 90-day period. From the peak rates of 125% to 145%, the US has also maintained a 20% base tariff on all Chinese goods, resulting in a combined 30% tariff rate. China agreed to suspend or remove additional non-tariff countermeasures and enacted since April 2025. This agreement is seen as a temporary truce, not the final solution, with both sides set to reassess after 90 days. If no further deal is reached, tariffs are expected to revert to a previous higher levels. Now, why do I think that this can lead to a recession in US? You have to understand tariff act as tax on businesses and consumers. In US, tariffs on Chinese goods reached as high as 145% before the recent temporary reduction. This led to an immediate spike in consumer prices. Simulations suggest US inflation could rise by over 5% due to higher costs for both input and finished products. The US-China trade war has sharply increased the risk of recession by raising prices, hurting exports, disrupting supply chains, and undermining business and consumer confidence. While the recent tariff reduction has eased immediate pressures, the economy remains vulnerable. Now, the situation is even getting worse because of the recent LA protest as the consumer confidence declines and the investor confidence declines. LA is a major port and logistics center for US-China trade. The recent protests have led a blockade of freeways, arsons, and disruptions in downtown LA. This can lead to a erosion in investor confidence. It will lead to heightened uncertainty and business anxiety. Political polarization and policy gridlock are not a signal that any investor look before investing. So investors who are coming in, bringing the money to America will now be asking for a premium before investing in US assets. Now, given the backdrop of all these protests that are happening and the US-China trade war, the risk of recession in US is relatively high now. With political radicalization, policy deadlock, investors will face anxiety whether they want to invest in US assets or not, with them demanding some amount of premium for US assets. So now let's talk about what's happening on the other side of the planet, specifically Indian markets. Indian markets have recovered after the battle with Pakistan and almost being in the bear phase for 6 to 7 months. Now Nifty 50 has touched almost 25,000. In the beginning of April, I invested a decent amount of capital in Motilal Oswal Defense ETF. This was done to protect my portfolio from the US China trade war and all the tariffs that US was imposing on all the countries. And I was looking for a place to hide my capital and a place to protect my capital. And I was specifically looking for domestic Indian sectors, and defense being the primary sector which is driven by government spending. So I invested a decent amount of capital in the beginning of April in this sector, and since then it has seen a decent amount of gains, and the bull run has happened in this sector. Now, this was entirely accidental. As I'm not a financial advisor, you should not listen to whatever I'm trying to say over here. But this was just pure luck and to some extent a coincidence that I moved my money to a domestic sector, which is defense sector specifically. But it got my attention so that I started digging deeper to understand what's the bigger story in this sector in India. If we see the nitty-gritty details of what's the defense story in India, there has been remarkable transformation in India's defense sector under PM Modi's leadership. He has been the primary driver to make India an export-oriented country in defense equipment. And over the last 10 years, the export have surged by more than 1,100%, rising from mere 1,900 crore in 2014 to almost 24,000 crore in 2024, with military hardware now primarily being supplied to over 100 countries across the world. But you have to understand that exports is not the primary story that is being played in India's defense sector. The primary story is indigenization. All the services of military, be it Navy, be it Air Force, be it Army, they are focusing towards getting more and more equipment that are manufactured by Indian companies that have technologies producing in India. And this is really important whenever you are in a situation of a conflict or a war. You do not want to rely on a single country for a critical piece of hardware that you need in a conflict. And this being one of the primary priority of the government because of national security, this trend is likely to continue. So both export-oriented trend and the indigenization trend will continue in future, in my opinion. Now, primarily, I have been a conservative investor, mostly investing in indexes and companies that I fully understand. So that's why my portfolio is relatively small, having only 12 holdings, which is a little bit unnatural compared to the other investors. So, if I walk through my holdings, I have primary investment in ICICI Prudential Mutual Fund Nifty 200 Momentum 30 Index. This index is tracking 30 best performing stock based on prices in Nifty 200 space. Now, as you can see, this has seen almost 15% correction now. I was sitting on a loss in this investment because I made positions in last year during July and September. And overall, like if you compare my returns to any FD returns, I am actually sitting on a loss on this entire capital invested. However, there are other significant bets that I took in same direction, which are small cap, momentum, and Nifty Alpha 50 index. Both of these are price movement based index. That means they do not care about the fundamentals of the company, and they mostly care about how the price is rising for a particular stock. They rebalance over every 6 months and every 4 months, respectively. One new position that I added in past 2 months is Motilal Oswal Defense ETF. This observed a decent amount of gain, almost 27% in past 1.5 month. And the reason I invested in this, and the time I invested in this was in the beginning of April when Trump was announcing his tariffs, and I saw this as an opportunity to protect my capital in this particular domestic sector. Along with this, in this portfolio, we have some diversification in real estate sector, which is primarily driven by Suntech Realty. Suntech Realty is a Mumbai-based real estate developer. It's a small cap company. They have been in the market for more than 20 years now. They have seen a downturn of 2008, and they maintain a healthy balance sheet with really low debt and have a good amount of projects in the pipeline, almost 30 to 40,000 crore, with a new expansion plan in Dubai. So I think the company's fundamental is strong. I got introduced to this company through another super investor called Manish Pabrai, and that's how I read about this company and I invested in this company. Next we have is some consumer play. This is mainly done by Varun Beverage, which is a beverage and a bottling company. They also own some brands like Sting, which is right now getting famous in India, having a sales growth of more than 25%, 30%. They're also planning an expansion in Africa. So I don't see a huge bull run happening in this stock. This is mostly going to grow at a rate of 10 to 20% with because of a price fluctuation going up to 25%. Then we have Tips Music. This is a new age company or a music company in which I invested. The business model is pretty simple. They buy already produced music either from the artist or from the producer, and they have the rights of that particular song for almost 50 years or 100 years. And they will be sharing some amount of revenue whenever a song is streamed on any kind of platform like Spotify, Ghana, Prime Music, YouTube, blah, blah, blah. Now, you have to understand these companies were loss-making companies 20 years ago because piracy was so easy and there was no accountability. As there are more streaming platforms coming into picture, they will be able to charge end consumers either by showing them ad or by membership or subscription revenue. So revenue streams for this company will increase if the streaming revenue of Spotify, Ghana, Amazon Music will increase. Also, I see as people will have access to phones, cheaper internet, cheaper access to like data in general, people will be willing to pay for these services as time goes on, as the cost comes down. So I see an organic growth in this company over a period of 10 years, 5 years, and I'm willing to hold this investment for this reason. Now, if you see, I have built position in this company in June 24, and I'm sitting on a profit of almost 8%, which is not significant, but there has been a fluctuation in the stock price. I am not building any new more position in this company right now. I might take it up to 4 to 5 lakh, but I'm waiting on this investment right now to see if how the results evolve, what's the commentary given by the company. Next, we have some amount of diversification in the data center and AI story through Anantraj and Motilal Oswal Nasdaq 100 and FANG ETF. Anantraj is a real estate company operating in India. They operate in consumer real estate, but they're venturing into data center business, and that's why I am an investor in this company. Uh, since the time I've invested in this company, I have only observed loss. The stock has corrected almost 30-35% in the beginning of April when the trade war was kicked off by US President Trump. And now I am still sitting on a loss of almost 14%. However, I've not seen the fundamentals of this company deteriorating over time. However, thing to note here is the company is still trading at a premium valuation of 46. So any new investment should be handled with caution. However, the company is still sticking to their story. Their sales is consistently growing and in line with the expectations that they're setting. Their data centers are up and running in Manesar and they're planning to expand even more. However, they are new to this business, and I want to see how they execute, how they build the clientele and client base before they can see that growth coming in. So I'll be a slow but steady investor in this company. I'll not take out my money in 1 or 2 months until I see a story changing drastically, even though I'm sitting on a loss over here. Apart from this, one more interesting thing to note here is how the promoter holdings have changed over time. After the QIP in 2023-2024, the promoters are now building up their position back up, like after the fall that happened in the month of March and in the month of April. Now, this is a good indicator for any stock. Why? The reason is when a investor or when a company CEO is thinking that, hey, I can make more money by investing this capital by buying shares rather than actually putting in the business, that's a good sign. But it can also be stock manipulation. So handle it with care. Then I have some amount of exposure in the entire AI story by Nasdaq 100 and FANG ETF. These are indexes that have only big tech stocks in their composition. FANG companies almost constitute up to 50% of Nasdaq 100 index. Now, I was an investor in this index almost in November or December 2022. I was sitting on a serious profit in last 1 or 2 years, almost 100%, 150%, and I decided to rotate that capital into defense ETF. And the reason is I don't feel confident that this story can sustain at such premium valuation anymore. I have to understand AI stories playing out, AI adoption need to happen. And most of the companies that are present in this index are trying to build the infrastructure that's needed for AI, not just uh, like the services that you can take with AI. So because these companies are like orienting themselves to set up the infrastructure like Facebook, like Nvidia, like Google, these companies are hyperscaler. So there will be a secular trend for all the companies that are present in this index. However, I'm a bit worried about the valuation and risk of recession because of the trade war that Trump has kicked off. And that's why I decided to reduce my positions in this index. No other reason. So, what's my strategy of either coming back or investing in this index? Now, I'm looking for some amount of clarity from the policy side in US and China before I come back into either of these index, either the FANG ETF or the Nasdaq 100 ETF, because both of these countries right now are into a active conflict or a passive conflict in multiple places. In Ukraine, to some extent in Taiwan and South China Sea. And I feel the entire Iran, Houthi, and US conflict is driven by China. So that's why until unless I see some amount of clarity, I don't feel comfortable investing in this because these companies can get affected dramatically by tariffs and trade wars. That's it for today's episode. I hope you enjoyed this video and find this content useful. Please hit the like button and subscribe to Vishal Wealth View because it will help support our community and help reach this video to more users. Bye bye. Happy investing. Take care.